In today's video, I'm going to talk to you about my top 5 picks of ETFs for this month of April 2021. Let's get down. Let's check these out. My first pick is the BMO Global Consumer Staples Hedged to Canadian Dollars ETF. Now, if you're Canadian, obviously this is the one that you would want to pick because, of course, when it's hedged, what that basically means is the fact that, of course, the currency is not going to be affecting it as much as the non-hedged one, which what I mean is if the stock goes up, let's say 10%, and of course, if the currency goes down 10%, that means that your actual net return is 0. So, of course, hedge is always good because I think that the Canadian dollar is going to continue to go up anyways, in my own personal opinion. So, what do we see? Well, of course, it's a low volume ETF, so it's going to be hard to get out of if it does start tanking. For an ETF, any ETF that's below like 50,000 volume average per day, if it starts tanking, it's going to be extremely hard to get out of it, so keep that in mind. However, with this ETF, it's the staples, it's the main stocks that you would want to invest in, and they are generally speaking pretty well protected against any kind of downturn minus the whole coronavirus thing. However, the downturn wasn't huge. It went down to $18 from $22, which is still a massive downturn, but again, it's not as big as what the market's seen and what other stocks have seen. So this one does sort of protect you against that kind of stuff, and it has recovered quite nicely. Really quickly though, the yield is 2.3% and the MER is 0.35. MER is how much it costs for you to hold the ETF. So for example, if you invested $100, it would cost you 35 cents per year to be able to invest in this ETF, mainly because they have real people making these trades, and of course real people costs money, or at least computers cost money. Now it does pay a dividend, which is nice. It does pay it at what seems to be every quarter, and of course that's nice to see. And at 12 cents being raised from 11, which was raised from 10, which was raised by 9.5, it seems to be a pretty solid ETF. You're getting a dividend raise what seems to be every single year, which is nice. And the companies that it holds are the biggest blue chip style companies there are. Procter & Gamble, Nestle, massive. Coca-Cola, Pepsi, huge companies. Unilever, again, huge. All of these companies are huge. The only one I disagree with is that one right there. However, it's a tobacco company and it's not going to be around for probably too long anyways, because less and less amount of people are smoking. People are smoking more weed, so that might be just eventually replaced with a weed company like Canopy in probably 10 years. Next is the Spider Portfolio S&P 500 Growth ETF. This is different than SPY. This is SPYG. The difference is because SPY invests in the market as a whole, while SPYG looks for the growth stocks of the whole S&P 500. This is actually an interesting way to invest because, of course, you're holding a massive amount of companies, but at the same time, you're getting the growth, which is what we all kind of want. The only thing is as a dividend investor myself, it has a low dividend of less than 1%, but I want to show you something that is going to absolutely blow your mind other than the volume being a little over 1 million shares. By the way, the MER is 0.04%, which means for every $100, they are going to charge you 4 cents to invest every single year. The huge thing is the fact that it went from $45 down to almost 30. It was like $31 or $32. That's a huge downturn, and that would have been an absolutely amazing time to buy. However, check this out. Huge growth, and now it's stabilizing. This is huge. This is what you want to see if you start wanting to invest in different ETFs. You want to see a little bit of a downturn and stabilization so that now you can buy when it's low and, of course, sell when it's high, or just don't sell at all and just wait until it goes to $1 million in a million years. Dividend growth is also kind of interesting. So, of course, we see the dividend up in 13, 14, 12, 14, 16 cent range. And then, of course, recently it's gone down. Well, could it be the coronavirus? Potentially, maybe. Biggest holdings of this ETF is Apple, Microsoft, Amazon, Facebook, Google, Alphabet, whatever you want to call it. Tesla, Nvidia, oh my god, I wish I invested in that when I invested in Facebook. That would have been beautiful. Oh my god, they were like $9 a share and now they're stupid money. PayPal and Netflix. So these are all like my top picks other than Microsoft. So like if you're looking to invest in any company that's going to make you money over the next 5, 10, 15 years, any of those will work. Even Microsoft will work. I just don't like the original owner of Microsoft. That's just a personal opinion of myself. Global X Lithium Battery is the next ETF because we know, or at least I've seen so many headlines, that the battery market is going to be just not enough. It's almost like what we're going through right now with processors, where there's going to be factories shutting down because there's just not enough things being made, not enough processors. Well, guess what? In the future, in probably 6 months to a year, there's going to be a shortage of batteries. The reason is because obviously there's more batteries being put into cars. However, that's not the main thing. It's the fact that these resources that make energy, for example, wind, solar, and of course, hydroelectric. Those three are going to be exploding, not just because of the Biden administration, but because of a worldwide trend of going more green, which is great. Let's face it, cleaner air is better. Could it get warmer in Canada? Yeah, I hate winter. But when it comes down to it, batteries, there's going to be a shortage. There's going to be a lot of companies, a lot of businesses needing batteries, a lot of governments needing batteries. And because of that, I think that this ETF right now at the price it is, because it's come back down a little bit, I think it's a great investment. It does trade on average 1.5 million shares per day. Its MER is actually extremely high for an ETF at 0.75, but the growth is there in my own personal opinion. It's currently trading at $60 per share, and it's had a stupid run up. Like, this has gone from $20 to $60 in a couple of months. And then even before this whole coronavirus thing, it was at 30, even if you held it all the way to the bottom, and now here, you have now still doubled your money. By the way, its ticker is LIT. And let's not forget, it does pay a little bit of a dividend too. Now, it doesn't seem like it's growing its dividend because of the companies that it holds. It would pay a dividend out of those held companies, but we can see that there are times where the dividend has been actually extremely high. We see that in the history of this ETF, and we can actually assume by going by the different months that it pays out that it could be either going down or could be potentially having occasional surprises. The biggest companies that this ETF holds, the biggest ones that I like, are Panasonic, Tesla. Those are the ones that I massively like. Not a huge fan of Samsung, but it doesn't matter what I care. It doesn't matter at all because those are all amazing companies. So, if you're looking for a great future investment, this may be the one. Now, this next one, ZWK, has been in videos, and almost a half of my videos. This is one of my favorite ETFs of all time. It pays a stupid high dividend. It was actually up to 10% back when I was buying this ETF, but the dividend percentage has gone down because, of course, the price of the stock has gone ridiculously high. Of course, the average volume is 36,000 shares traded on average per day, and its MER is 0.65%. That's actually gone down recently, which is interesting and nice to see. It used to be 0.75. Now, of course, this is not a very old ETF. This has grown from just over $30 per share. It grew up to $32. Then it tanked, and now it's recovering nicely. So what I think was going to happen right now is it's going to trade sideways for a bit, and then you can grab that 7.5% dividend, and then eventually it's going to come back to the top, probably over the next year or two, or over the next year. I would say that this will probably reach in the range of $32 to $33. It's not a massive growth stock at this point. However, you are getting a massive dividend. What a covered call strategy is basically you're holding the stock, you're selling call options against those stocks that you hold, and then you get that premium, which is why that dividend is so high. I also really like the way that BMO structures their covered calls. They are out of the money covered calls, so basically there's a very small chance that those call options actually get used, or I guess basically ran, I guess you could say. There's more technical terms. I'm trying to keep this as simple as possible, but with it being way out of the actual price that it's at, this seems pretty safe, and it seems to be continuing to grow its equity anyway, so I kind of like that ETF. It's also slightly grown its dividend from 15.5 cents per share all the way up to 18 cents, so that's nice to see as well. These are its largest holdings, JP Morgan and Goldman Sachs, Citigroup, and Bank of America being the biggest that everyone tends to know. Bank of America being actually my favorite out of them all. And of course, the brand new ETF that I actually have a dedicated video to, but ARK ETF Trust, which is an ARK Space Exploration and Innovation ETF. It's actually only 3 days old, which is amazing. And its yield is unknown, probably not going to have that much of a yield. Volume is also technically unknown because, of course, it's only been available for 3 days, but 6.5 million shares traded the last day it was traded. It's gone from around $20 a share up to about $21 a share, which is actually a pretty good growth return over 3 days of being out. But again, we have to remember that this is a brand new ETF. We cannot see the history, but anyways, you can't really guarantee the history anyways. What you can do, however, is research the companies that, of course, they invest in. And, of course, these companies that they invest in are orbital aerospace companies, suborbital aerospace companies, companies that enable technologies that will be helpful for either artificial intelligence, robots, 3D printing, materials, and energy storage for space exploration, and also aerospace beneficiary companies, for example, GPS, satellites, internet satellites, air taxis, electric aviation vehicles, and that kind of a thing. From there, also, it has a 0.75% MER, which is not the greatest. It's kind of high, but this is an active fund by Cathie Wood, and I actually really like it. And you can, of course, go check out the dedicated to that ETF video as well, somewhere on my channel. Anyways, I hope that you have enjoyed. Actually, that video is coming out very soon. I hope that you have enjoyed today's video. If you have, hit that like button and subscribe. Remember, never trust a random YouTuber on the internet. Always do your own research, and I'll see you guys again in my next video.